Hey everyone, welcome back to Stock Predictor. Today we're diving into a super important topic: 3 stocks to buy and 3 stocks to sell before 2026. We'll walk through why each of these picks makes sense or doesn't, what to watch out for, and how they could play out in the next 12 to 18 months. So grab your coffee, hit that like button, subscribe if you haven't already, and let's get into it. Let's start with the buys. These are companies I believe have favorable outlooks heading into 2026. Buy number 1. Company A. Let's call this Company A for now. You can fill in the ticker in your own notes. What makes Company A compelling? First, they operate in a high-growth sector, think technology, cloud services, or renewable energy, where demand is accelerating. They've shown strong revenue growth the past few quarters, and their balance sheet is in decent shape. Second, they've got a competitive advantage, perhaps a unique product, strong brand, or a network effect that makes it harder for competitors to dislodge them. Third, the market may be underestimating the growth potential. If the stock has pulled back or the broader sentiment is muted, that could be an opportunity. Risks. As always, execution risk. Will they deliver on their promises? Macro risk, economic slowdown, interest rate hikes, and valuation risk. A high price leaves little room for error. If you buy Company A, set your target and your stop loss or know your exit strategy. In my view, if they hit their milestones, Company A could see a material upside by 2026, maybe 30% plus if all goes well. Buy number 2. Company B. Company B is my second pick. This one might be a more safe growth buy, perhaps a company that already has solid market share, decent profitability, and a clear path to incremental growth rather than just moonshots. The logic: in a world where volatility remains high, having a stock with more stable fundamentals can be attractive. For example, they might be expanding into new markets, launching new product lines, or benefiting from tailwinds like digitalization or shifting consumer behavior. The margin trends might be improving, which means earnings could surprise on the upside. Of course, we must watch regulatory risk, supply chain risk, and competitive threats. If you buy Company B, you're banking on both execution, they continue to manage costs and grow, and that the market rewards that improvement. By 2026, it's conceivable Company B delivers moderate but solid returns, perhaps 20 to 25% or more depending on market conditions. Buy number 3. Company C. Finally, Company C is a longer-term play with a bit more risk but potentially higher reward. Maybe they're investing heavily now, which weighs on near-term earnings, but the investment could pay off big in 2 to 3 years. Think of a company poised for a new product launch, geographic expansion, or disruptive innovation. The thesis: you buy now while the market is cautious or waiting, and you ride the wave when things come together. But the risk is higher. Things could go sideways or take longer than expected. If the narrative works, though, Company C could deliver outsized returns by 2026, maybe 40% plus or more. When you go for Company C, be mentally prepared for some volatility and possibly patience. Now let's switch gears and talk about the sells. These are stocks I believe have increasing risks, weaker outlooks, or simply better uses of capital elsewhere. Sell number 1. Company D. Company D looks attractive on the surface. Maybe large brand, lots of cash, strong recent results, yet I believe the risk now outweighs the reward. Why? Perhaps growth is slowing, margin pressures are rising, competition is ramping, or the valuation is already rich, leaving little room for error. So for Company D, the sell case is: you're locking in gains before the market starts pricing in weaker growth, or you're avoiding a trap where performance dips and sentiment flips. If you're holding this stock, ask: is the future better priced in than you think? If yes, maybe it's time to reduce or exit. By 2026, I expect this stock could underperform the broader market or even decline if multiple risks line up. Sell number 2. Company E. Company E might be functioning in an industry facing headwinds, regulatory issues, shifting consumer preferences, supply chain disruption, or secular change, e.g., legacy business model being disrupted. The company may have been safe in the past, but I believe the tailwinds are turning into headwinds. For investors, the question is: are you willing to ride out this transition? If you believe the transition might fail or the outcome is uncertain, a sell makes sense. By 2026, the risk is that Company E either stagnates or declines, and the opportunity cost holding it versus better growth names becomes meaningful. Sell number 3. Company F. Finally, Company F is perhaps the most speculative of the sells, a company that might be relying on hope more than fundamentals. Maybe they have high expectations priced in, new product, turnaround story, etc., but execution risk is elevated, cash burn is high, or they're at the mercy of macro external factors. If you're betting on Company F, you're essentially taking a chance. If you prefer certainty or want to reduce risk, exiting might be the smart move. By 2026, this stock may disappoint or even see a significant downside if the hope-driven narrative doesn't play out. How to navigate all this? Here are a few guiding principles as you decide which stocks to buy or sell. Define your time horizon. Since we're looking toward 2026, you're thinking 12 to 18 months out or slightly more. Make sure you're aligned with that period. Set objectives and risk tolerance. Are you chasing high returns and willing to take high risk, or are you more conservative? That will determine which picks are suitable for you. Diversify. Even good ideas fail. Having a mix of higher risk, higher reward and more stable names helps smooth performance. Monitor catalysts and triggers. For each company, identify the key milestones or events you're watching. Product launches, earnings growth, margin improvements, regulatory decisions, etc. Exit plan. For both buys and sells, know in advance your exit criteria. For buys, what would make you hold or sell? For sells, are you fully exiting, trimming down, or maybe hedging? Stay nimble. The market changes. Macro environment, interest rates, regulation, consumer preferences, all matter. Be ready to adjust. Why this matters right now. Heading into 2026, a few macro themes are worth noting. Interest rates and monetary policy remain key. Higher rates tend to weigh on growth stocks. Inflation and cost pressures are not fully gone. Companies with weak margins or high cost bases are vulnerable. Sector rotation could accelerate. Growth names might lag if value or cyclical stocks regain favor. Technological disruption and regulatory change continue to reshape many industries. Companies on the wrong side of disruption could suffer more. Sentiment and valuation risk are real. Even good companies can underperform if expectations are too high and the market punishes any misstep. Given all that, rationally choosing which stocks to buy and which to sell becomes very important. It's not just about picking winners, it's also avoiding losers. Summary. So to recap, buys. Company A, high growth, competitive edge. Company B, stable growth, improving fundamentals. Company C, higher risk, higher reward. Sells. Company D, valuation risk, slowing growth. Company E, industry headwinds, transition risk. Company F, hope-driven story, execution risk. Use clear criteria, stay aligned with your time horizon, monitor key catalysts, and maintain an exit plan. Remember, avoiding a bad investment can be just as valuable as finding a great one. Thanks for watching, and if you found this helpful, please give the video a thumbs up, leave a comment with which stock you're bullish or bearish on, and don't forget to subscribe for more updates here on Stock Predictor. Hit the notification bell so you don't miss our next deep dive. Until next time, happy investing and stay informed.